Something extraordinary is happening in the world of global finance, and most people have no idea what it means. Chinese billionaires have quietly moved $47 billion into physical gold over the past 18 months. Not gold stocks, not gold futures, actual physical gold bars sitting in vaults. And they're not the only ones. The People's Bank of China just completed their 11th consecutive month of gold purchases. Chinese insurance companies are restructuring their entire investment strategies around precious metals. Wealthy families in Shanghai and Shenzhen are converting cash into gold coins at record rates. But here's what should terrify you. They're not buying gold because they know a guaranteed event is coming in 2026. Analysts suggest they may simply be preparing for broader economic uncertainty, not a specific predicted crisis, something that will make the 2008 financial crisis look like a minor correction. When the world's second-largest economy starts hoarding the one asset that has survived every economic collapse in human history, that's not investment advice, that's a warning signal. And right now, every indicator that preceded the last three major financial crashes is flashing red simultaneously. The debt levels, the currency instability, the geopolitical tensions, the loss of confidence in traditional safe havens. We've seen this pattern before. We know how it ends. The only question is timing. And while some investors believe the mid-2020s may be a volatile period, this is speculation, not confirmed prediction. Despite billionaires moving mountains of money into gold vaults, this isn't speculation. This is documented strategy by some of the most sophisticated financial minds on the planet. People who have access to information you and I will never see. People who have survived multiple economic collapses and know exactly what the warning signs look like. And they're all doing the same thing, converting paper assets into physical gold as fast as possible. Let me show you exactly what they know, why many of them are positioning cautiously for the coming years, and what it means for everyone else who isn't paying attention. The story starts with a man most people have never heard of, Bian Shiming. Born in 1963 in a small township during China's Great Leap Forward, he built his fortune manufacturing plastic tubes. Not exactly the background you'd expect for someone who just made $1.5 billion predicting market shifts. But Bian saw something others missed. While everyone else was focused on technology stocks and cryptocurrencies, he was studying history, specifically what happens when currencies lose credibility and governments can't pay their debts. In 2023, when gold was trading around $1,900 per ounce, Bian started accumulating massive positions in Chinese gold futures. Not because he loved gold, but because he understood that when trust in paper money evaporates, people run to the one asset that can't be printed, diluted, or manipulated by central banks. His timing was perfect. Gold has since exploded past $4,000 per ounce, and Bian's billion-dollar profit is just the beginning. But Bian isn't operating in isolation. He's part of a coordinated movement by Chinese financial elites who have been systematically reducing their exposure to dollar-denominated assets for the past 3 years. The numbers are staggering. China has reduced its holdings of U.S. Treasury securities from $1.3 trillion in 2011 to approximately $800 billion today. That's $500 billion that had to go somewhere. And it's going into gold, physical real estate, and strategic commodities. The Chinese central bank's gold buying program reveals the scale of this shift. 11 consecutive months of purchases, adding over 5 tons in the third quarter alone. Their officially reported reserves now exceed 2,200 tons, but industry experts believe the real number is much higher. China has a history of understating their gold holdings for strategic advantage. When your goal is to reduce dependence on the US dollar without triggering a currency war, you don't advertise your exact strategy. This systematic accumulation becomes even more significant when you understand the catalyst. The freezing of Russian central bank assets in 2022 demonstrated that foreign currency reserves aren't actually safe from geopolitical sanctions. $300 billion in Russian assets were frozen overnight, proving that holding dollars or euros is a political risk, not just an economic one. Chinese leadership took notes. If it happened to Russia, it could happen to anyone who challenges Western hegemony. But the institutional buying is just part of the story. Chinese household demand for gold has exploded. Gold coin and bar purchases jumped 77% year over year, reaching a record $12.7 billion. Gold withdrawals from the Shanghai Gold Exchange hit 118 tons in September alone. This isn't investment diversification. Many analysts view this surge as precautionary behavior during uncertain economic cycles, not evidence of an imminent systemic breakdown. The insurance industry tells an even more alarming story. Chinese insurance companies collectively manage over $4 trillion in assets. Recent regulatory changes are pushing them toward gold allocations. Even a 1% shift represents $40 billion in new demand. When institutions managing retirement funds and life insurance policies start buying gold, they're not speculating on price movements. They're typically seeking long-term stability and diversification, in response to changing regulations and market conditions. Here's where the 2026 timeline becomes critical. Multiple forecasting models point to the same convergence point. The US debt spiral reaches mathematical impossibility. Interest payments on the national debt exceed defense spending. Social Security and Medicare face funding shortfalls. The Federal Reserve faces an impossible choice between defending the dollar and preventing economic collapse, and China completes its transition away from dollar dependency. However, these are theoretical stress test scenarios used in financial modeling, not certainties or guaranteed outcomes. The technical analysis supports this timeline. JP Morgan Research expects gold to average $36.75 per ounce by the final quarter of 2025, rising toward $4,000 by the second quarter of 2026. But those are conservative estimates, assuming gradual change. If geopolitical tensions accelerate, if the dollar's reserve currency status comes under direct attack, prices could move much faster. TD Securities suggests that if China accelerates their de-dollarization program, gold could reach $6,000 to $7,000 per ounce. Veteran analyst Ed Yardeni forecasts $5,000 for 2026 and potentially $10,000 by 2028. These aren't random predictions. They're based on mathematical models of what happens when the world's reserve currency loses credibility and everyone runs for the exits simultaneously. But like all financial forecasts, these outcomes remain speculative and depend on many unpredictable global factors. The parallels to the 1970s are impossible to ignore. Nixon's termination of the gold standard triggered a 4-year bull market where gold prices increased 2,300%. The current situation has all the same elements: massive government deficits, currency manipulation, geopolitical instability, and loss of confidence in traditional monetary systems. But this time, the scale is global, and the stakes are exponentially higher. Still, past patterns don't guarantee future results. They simply offer historical context. Chinese billionaires aren't just buying gold, they're positioning for the end of the Bretton Woods system that has defined global finance since World War II. Some analysts interpret these moves as preparation for long-term structural changes in the global economy, not the literal collapse of current systems. They're preparing for a world where the US dollar is no longer the universal medium of exchange, where gold becomes the ultimate store of value, and where governments that prepared survive while others collapse. The mechanism driving this transformation is more sophisticated than simple fear. Chinese financial institutions are executing what economists call the debasement trade. When central banks print money to finance government spending, they dilute the purchasing power of existing currency. Gold becomes the natural hedge because its supply cannot be artificially increased. The People's Bank of China understands this better than most. They've watched the Federal Reserve expand the money supply by 400% since 2000, turning dollars into a depreciating asset disguised as a stable currency. But the Chinese strategy extends beyond portfolio protection. They're building the infrastructure for a post-dollar world. The Shanghai Gold Exchange has become the largest physical gold trading platform globally, processing over 2,000 tons annually. Chinese banks are offering gold-backed loans, gold savings accounts, and gold-denominated trade financing. This isn't preparation for higher gold prices. This is preparation for gold to resume its historical role as international money. The timing aligns perfectly with China's broader economic strategy. The Belt and Road Initiative, digital yuan development, and bilateral trade agreements with Russia, Iran, and other sanctioned nations all point toward the same objective: creating alternative systems that function independently of Western financial infrastructure. Gold provides the foundation because it's the one asset every central bank recognizes as legitimate money, regardless of political relationships. Meanwhile, Western institutions are moving in the opposite direction. European pension funds are required to hold government bonds that yield negative returns after inflation. American retirement accounts are concentrated in stock markets trading at historically extreme valuations. Insurance companies are loaded with corporate debt that becomes worthless if interest rates spike. The contrast couldn't be starker. Eastern money flows into hard assets, while Western money remains trapped in paper promises. The insurance industry restructuring reveals how deep this transformation goes. New regulatory guidelines encourage Chinese insurers to increase commodity allocations from 2% to 5% of total assets. With over $4 trillion under management, that represents $120 billion in additional demand for physical assets. Gold, silver, platinum, even agricultural commodities are becoming mandatory portfolio components. When institutions responsible for paying future claims start hoarding real assets, they're signaling that paper currencies won't maintain purchasing power. Analysts emphasize that this shift is strategic diversification, not a prediction of currency failure. This institutional behavior creates a feedback loop that accelerates the timeline. As Chinese entities entities reduce dollar holdings, they must sell treasury securities to buy gold and other hard assets. Increased treasury supply pushes yields higher, making U.S. debt service more expensive, forcing more borrowing or money printing. Either choice weakens the dollar further, justifying more gold purchases by anyone paying attention to the cycle. The mathematics become unavoidable at some point. The United States currently pays nearly $1 trillion annually just to service existing debt. Every percentage point increase in interest rates adds hundreds of billions to that burden. If rates normalize to historical averages, debt service could exceed $2 trillion per year. That's more than the entire federal budget in 2000. The only solution becomes money printing on a scale that destroys currency credibility entirely. Economists debate these scenarios, stressing that outcomes depend heavily on future policy decisions and global conditions, not predetermined collapse. Chinese billionaires are positioning for that exact scenario. They've studied what happened to the British pound during the 1970s, to the German mark in the 1920s, to every reserve currency that overextended itself throughout history. The pattern is always identical. Initial confidence, gradual decline, sudden collapse, and flight to tangible assets. Gold has survived every single monetary system failure across 3,000 years of recorded history. The geopolitical dimension adds urgency to the timeline. China's military buildup around Taiwan, Russia's resource diplomacy, Iran's nuclear program, and North Korea's missile tests aren't isolated events. They're coordinated challenges to American global dominance. Each confrontation forces the United States to choose between military response and economic consequences. Military action requires massive spending. Economic sanctions reduce dollar demand internationally. Both outcomes weaken America's financial position. Still, these developments represent geopolitical tensions, not guaranteed indicators of economic collapse. Chinese strategists understand that military defeat isn't necessary. Financial exhaustion achieves the same result more efficiently. The Soviet Union collapsed not from invasion, but from economic implosion. The British Empire ended not from conquest, but from debt overextension. Spain fell from global dominance when their silver stopped flowing. The pattern repeats because the mathematics are inescapable. Smart money recognizes these historical precedents and positions accordingly. Bian Ximing's billion-dollar gold profit demonstrates what happens when you understand monetary history instead of believing in monetary permanence. His success has attracted attention from other wealthy Chinese families who are now following similar strategies. Private wealth managers in Hong Kong report unprecedented demand for physical precious metal storage services. The wealthy are also diversifying geographically. Chinese billionaires are purchasing real estate in Singapore, Switzerland, and other stable jurisdictions. But they're not just buying property. They're establishing residency rights, opening bank accounts, and creating legal structures that provide options if capital controls are implemented. Gold purchases complement this geographic diversification because gold maintains value regardless of location. The warning signs are impossible to ignore once you understand the pattern. $47 billion doesn't move into gold vaults by accident. Chinese billionaires, central banks, and institutions aren't preparing for 2026 because they want to be right. Many are simply preparing for a wide range of potential economic outcomes, not a guaranteed breakdown. They're preparing because they can't afford to be wrong. The mathematics of debt, the fragility of currencies, and the shift away from dollar dominance point to the same conclusion. When the world's smartest money starts hoarding the one asset that survives every collapse, it becomes a signal of caution, not a confirmation of an inevitable global crisis.